When banks accept deposits, they can take most of that money, but not all of it, and lend it out. This can benefit everyone: depositors, lenders, and the bank. Let's see how it all works. Suppose a company deposits $10,000. If the regulations say the bank needs to keep only 10% in reserve, it can lend out $9,000. Why do banks need to keep some money in reserve? One reason is that if they loaned it all out, they wouldn't have any left for customers to withdraw. When banks keep only a fraction of their money in reserve, it's known as fractional reserve banking. So, getting back to the $9,000 the bank can lend, let's say it's used by another business to pay wages. Now the workers have the $9,000 among them. Let's assume they each decide to save all of their money in their bank. So the $9,000 comes back into the banking system and it begins again. The bank keeps 10%, $900, in reserve and lends out another $8,100. This practice of lending everything but the reserves can keep going through many cycles before there's nothing more to lend. But what happens if everyone tries to withdraw their deposits from the bank at the same time? A bank run occurs. Since the bank has lent out the majority of the money its depositors put in their accounts, it won't be able to pay out in cash all the money that people might want to take out. But under normal circumstances, people keep their money in their accounts, and banks are able to predict how much they can lend out without causing them to run out of funds. Today, bank runs are usually headed off before they begin by the action of the Federal Reserve through loans to banks and the actions of other banking regulators, such as the Federal Deposit Insurance Corporation and the Office of the Comptroller of the Currency.